Hi, I'm Josh Misk, Vice President of Investments at Invisor. Welcome to our monthly update for November 2015. If we look at the market in November, it's a continued slow growth environment that we're experiencing, and equities across the globe started to level out a bit after their really strong performance in October. If we look at Canada, that slow growth environment has put a lot of downward pressure on commodities, in particular ones that are sensitive to the growth environment, like industrial metals or oil, and which also make up a big part of the Canadian economy. If we look over to the U.S., equity markets were flat in the U.S. as well, but if we look at bonds, especially bonds in the short term, interest rates started to increase and widen out as investors really started to increase their expectations of a federal rate rise in mid-December. So when we look at that rate rise, we can look at some of the reasons why it's starting to happen, why expectations are increasing. And there's a few points to consider. First of all, bank lending is really coming back strong. It's up $800 billion over last year. When we look at what was going on 2 years ago, it's a big contrast to that, where there was a prolonged period of banks accumulating reserves, and they're relatively unwilling to lend to the private sector. So what this tells us now is that banks, as well as businesses, have a lot of confidence in the future. Now, if we also look at the employment numbers, employment's up at peak levels right now. Wages are up over 4.5% over last year. And what that has done is that's driven consumer spending up about 3% over last year. And that's good consumer spending. When it's driven on higher wages rather than borrowing and lending, it's a much stronger and more sustainable number. And finally, if we look at inflation over the past year, which is the major metric that the Fed is looking at when they're increasing their rates to combat higher inflation, inflation has actually been at 0% or so over the last year. But if we strip out oil, which has decreased quite a bit, it's actually more in around 2%, which is right in at the 13-year average. So it's at that 13-year average despite all the sluggish growth over the past 13 years. So I think what that all tells us is that the economy in the U.S. is really ready to handle a rate rise, and it is one that we expect to see soon. Now, while we're looking at the U.S. environment where they're starting to tighten and try and restrict that growth a little bit and put a cap on inflation, when you look at global markets in general, central banks across the globe are still in an expansionary phase where they're trying to pump more money into their equity markets and to try to combat this slow growth environment that we're seeing across the globe outside of the U.S. And why are we seeing that? Well, I think that the largest problem is that in emerging markets, which have been an engine for growth over the past year, we're really starting to decelerate. And if we look at debt levels in several emerging markets, they're really getting to unsustainable levels. So why is that? Well, if we look at when the rich world bubble burst back in 2008, the interest rates in the developed world went to historic lows. And what that did was that drove a lot of capital out of these developed markets in search for yield, and a lot of it found its place in emerging markets. And some of that capital went to finance bad debt and to purchase overpriced products. Overall debt in emerging markets has actually soared from 150% of GDP in 2009 to over 195% today. Now, with slower growth and a stronger US dollar, countries that lack the means to bail themselves out or protect themselves from capital flight are at the most risk. Those which have high inflation or high foreign currency denominated debt, like Brazil, Malaysia, and Turkey, are really the ones that fall into that bucket. But that's not shared across all emerging economies. If you look at India and Russia, for example, they're in a much better position. China, although borrowing is at an all-time high and exports are low and inflation and production are decelerating, China actually has about $3.5 trillion worth of reserves on their books, and they've showed an appetite to bail out borrowers if need be. So we don't think the picture there is quite as bleak. When we look over to Europe, spending is down after the Paris attacks this past month. Tourism is down in Europe. but we don't see that as a long-term trend. In fact, business activity numbers that came out in October were up at their 4.5-year highs. So going forward, we do expect it to be a low growth environment, but we do think that the risks may be overstated. We continue to look towards the U.S. as the plow horse economy to drive us through this. Americans' household debt is at the lowest percentage of income that it has been in a long time. They're producing more, they're earning more, and they're spending more as a result. In this low growth environment, we expect capital to seek out higher yields and safer environments, and I think that bodes well for the American dollar and the American economy, given that they will be increasing rates. So that's it for our November update. Thank you for watching. We'll be back again in the new year, and happy holidays from all of us here at Invisor.